We are facing a valuation shock across multiple different asset classes. Back in 2019, our economy was already slowing and there were worries that we were going to enter a recession. Why were there worries of us entering a recession? Because of the slowing economy. But that was when in 2019, the Federal Reserve Bank started cutting interest rates to start stimulating an already okay economy to prevent economic pain. We weren't already in a recession, but we were seeing the economy slow down. And to prevent us entering a recession, to prevent that pain, that was where the Federal Reserve Bank back in 2019 started cutting interest rates to stimulate the economy. And this then caused the valuations of assets to rise. And this was assets like stocks and startups and real estate. All different types of assets started to rise because now when interest rates go down, people can access more money, which means more people can get more money to buy things. When demand goes up, well, that can push the prices of things up. And then came the year 2020 when the pandemic hit and interest rates were cut to their lowest levels ever, not to mention the fact that there were trillions, not billions, but trillions of dollars worth of stimulus, quantitative easing, and loans created to help stimulate the economy. You could think of it like this. You wanted to go out and buy a $500,000 home. Now, if you were the only person making an offer to buy the $500,000 home, you might be able to get it for $500,000, maybe even $475,000. But if you make an offer to buy that $500,000 home, and in the first 24 hours of the home being listed, there's 40 other people making offers on the home, well, that home might sell for $600,000 instead of $500,000. And that's exactly what we saw happen after the pandemic because interest rates were so low and people could access more money. But this wasn't just occurring in the housing sector. It was happening in asset class after asset class, which is why people called it the everything bubble. On one hand, we saw startup valuations skyrocket as all these dollars chased the limited amount of companies that were out there. We saw stock prices skyrocket because investors needed a place to put their money. And of course, we saw the same thing happen in the housing market. We all remember how fast home prices were shooting up in 2020 and 2021 because everybody wanted to go out and buy a home. Everybody wanted to access the cheap debt, but there was a low inventory of homes available for sale, which caused home prices to shoot up. Now, at that time in 2021, even into 2022, it seemed like nothing bad could happen because everything was booming. The prices of everything was rising. Money was easy to access. Profits were booming, and it seemed like nothing bad could happen, but nothing can go up forever. And then towards the end of 2022, that was when the concerns started coming out about the inflation problem. And then in 2023, that was when the tide really started to go out. We started to see interest rates start to go up in 2022, but the effects of that started to be seen towards the end of 2022 into 2023. And now here we are in the middle part of 2023, and now people are starting to get worried about the effects of the higher interest rates to bring inflation down. And this is where, again, if you just blindly follow what everybody else does, if you blindly listen to what everybody else does, you're going to be blind to what's actually happening. And this is where understanding rising interest rates cause economic pain. Why? Because it makes borrowing money more expensive. What does that do? It hurts spending. Our economic system runs on spending. The more money you spend, the more money somebody else makes. And so now when we were in an economy that was fueled by easy spending, easy access to money, easy just free-flowing credit, and now you take that away, there's going to be a shift. All the excess hot air is going to come out. And it takes time for it to come out. I mean, the Federal Reserve Bank is still trying to figure out how much more they want to raise interest rates, where they're going to raise interest rates to, what's going to happen with inflation. But we're starting to see some of the hot air come out. We saw it happen with some of the big banks here in the United States. But this is going to affect many different industries, not just banks. It's going to hurt many other corporations because corporations have borrowed billions of dollars over the last number of years because interest rates were so cheap. We've seen it happen especially in the corporate real estate market because there's a big shakeup in the real estate sector after office real estate has gone vacant and corporate real estate debt isn't all 30-year fixed rate mortgages. We also have a lot of consumer debt, which is skyrocketing, credit card debts, which are hitting new record highs, which are also variable interest rate debts. And we also have the highest level of national debt ever. All these things are going to cause some sort of consequences. And this is where now the question is, what is going to happen with interest rates? Because that's going to affect valuations. Like in the startup space particularly, and I think the startup space is interesting because we were starting to see a slowdown in the startup space in 2019 because of the slowdown in the economy. But then when the Fed started cutting interest rates, all of a sudden you saw this fresh new inflow of capital because now venture capital firms, banks, and these investment institutions were able to access a lot of money for very cheap. And when you can borrow money for very cheap, you don't need the best return. You just have to be able to beat the interest rate that you have to pay. And so now, if you can borrow money, say, for 3%, you only really need an 8% return on your money to justify investing your money. Where are these investments? Well, startups particularly. And same thing in 2020, when interest rates fell to the lowest levels ever. Now, institutions, banks, and venture capital funds were getting money hand over fist, and they needed a place to put their money. And where was this money going? It was going into startups, particularly in the tech industry. And we saw this massive boom in tech companies and startup companies. It wasn't just tech, but a lot of them were tech. And so now these companies were able to raise money at insane valuations. And I can tell you this from experience because as somebody here on YouTube, I saw it from two different folds. Number one, I invest in companies. And so I was able to see the valuations of companies that just didn't make sense. There was companies, I remember one reached out to me. They had, I think it was 10,000 email subscribers, or maybe it was less than 10,000 email subscribers. And they were claiming that because they have about 10,000 people signed up to their email list, they have a multi-million-dollar valuation on the company, which was really interesting because if you go out and run some Facebook ads, you can get 10,000 email subscribers for $40,000, $50,000. So it was an interesting thing to see. And they were valuing themselves at multi-million dollars. And it wasn't just that they were valuing themselves, they were getting these valuations from other investment firms, meaning investment firms were throwing money at them with these types of valuations. Plus, on the advertising side, here on YouTube and with Briefs Media, my newsletter company, there was a lot of companies spending big dollars on advertising. And they were willing to spend big dollars on advertising because they had big pockets. Investors wanted them to spend money on advertising. They wanted them to grow. And so it was great for creators because advertising dollars were through the roof. YouTube ad rates were skyrocketing. Now you're seeing the opposite, where businesses are saying, okay, we're not able to get that cheap money like we could before. Businesses that are not or were not profitable cannot get access to the same money because venture capital firms are saying, I can't borrow money at 3% anymore. I have to go out and borrow money at 7, 8, 9, 10% because they have to pay a premium to borrow money. I have to borrow money for higher rates, meaning if I'm going to invest my money into you, me as the venture capital firm, you as a startup, I need a better return from you. I need you to make a profit. And now a lot of startups are saying, profit? What do you mean profit? We're in our growth phase. We don't want to make a profit. We just want to gain market share, meaning we want to lose money. That way we can get bigger, faster, and maybe make a profit in 5 or 6 years. And so now there's a huge shift in that culture where now startups are being forced to try to figure out how to make a profit. Now, how do you make a profit? You got to make more money and you got to cut your costs. It's a little difficult to make more money when you're in a slowing economy. And we are factually now in a slowing economy because we got our most recent GDP data, which said that our economy grew by 1.1% when it was expected to grow by around 2%. So yes, our economy is slowing. And so now startups are having a tougher time trying to earn more money because, well, our economy is slowing. And then on the second end, it's by cutting costs. And this is why we've been seeing so many companies across the country now do layoffs. And this is from big companies to small companies where we've been seeing more and more layoffs because companies are now having to figure out how they can stay in business without the help of venture capital firms, without the help of banks, without the help of institutions. And this is causing a huge shakeup in that startup culture. And along with that then comes valuations, because when the money is easy to find, people are throwing money at you left and right, valuations also skyrocket. Why are valuations skyrocketing? Because everybody wants to own a piece of the company, right? Because when there's money that's free flowing out there, there's a lot of bids on these companies, just like buying a home. If you have 40 bids to buy a $500,000 home, that home could sell for $600,000. If there's only one bid, it might sell for $475,000. And so what's been happening with things like startups is over the last number of years, valuations skyrocketed. And that was partially due to the fact that there was so much easy access to capital out there. With the easy access to capital, everybody was trying to throw their money at these startups, thinking that every startup was going to be the next Amazon or hopefully the next Google. And startups were seeing huge success. I mean, success at the time was raising money and hiring employees, and it was a great time because there was so much money free flowing. But now it's all coming together where inflation has happened. Inflation happened because we had all this excess money enter our economic system. So this inflation now happened. And inflation then affects the average person because when you have high inflation, you have to spend more money on your rent and your groceries and your car, and you have less money to go out and buy other things. And this is where the Federal Reserve Bank eventually said, all right, this inflation problem is definitely getting out of hand. We need to now slow this money process. We need to slow this money system. And the way they do that is by raising interest rates. Now, when you raise interest rates, the valuations start to fall because now you raise interest rates. Venture capital firms say, I can't keep throwing money at your startup that's losing money. And now hedge funds and institutions are saying the same thing. And so now the startups that were reliant on this easy capital can't get access to more money. And then you see the same thing happen. Again, this is not just startups, this is every asset class. You see the same thing happen in the stock market. Institutions, hedge funds, banks were borrowing money so cheap that way they could buy companies, do mergers and acquisitions, do stock buybacks. Well, when interest rates go up, it's much more difficult, meaning much more expensive to do so. And so now the chief financial officers are saying, maybe we shouldn't purchase this company right now at this price. Maybe if they give us a 50% discount, we'll consider buying it, but we can't do that right now. Maybe we shouldn't open that new store right now because we're not getting a return big enough to justify the billions of dollars of debt that we'll have to do. So this then causes a further slowdown in the economy, but going back to the valuations, that also means that valuations, things like stock prices also begin to fall because when valuations fall, well, that means the value of your stock portfolio gets hurt. That means the value of your startup portfolio gets hurt. And real estate has been one of those interesting sectors, from housing to commercial real estate, where on one hand, real estate is a lagging industry. Even when the 2008 crash happened, remember the 2008 crash started in the real estate sector and then trickled down into every other part of the economy. But the stock market ended up bottoming out around 2009, 2010. The real estate market didn't bottom out until 2012. And in 2012, the stock market was on the verge of breaking new record highs. So the real estate market is a lagging sector. And now what we're seeing happen is interest rates are rising and people are still buying homes. And it's creating a unique dilemma for the Federal Reserve Bank because now when they look at the inflation numbers, they're saying, okay, real estate is one of the biggest components in CPI, inflation. And in order to cool down inflation, they need home prices to not grow so significantly. If they want home prices to not grow so significantly, they need people to buy less homes. If they want people to buy less homes, that means you need higher interest rates. And you can start to see where the dilemma is. And this is something I feel like for the last 6 or 8 months, I've been saying this month after month, where the next Federal Reserve Bank is more crucial. And each month it keeps getting more and more crucial because we're seeing more and more of this balance between inflation and the economy. The Federal Reserve Bank is raising interest rates. And it's like a teeter-totter. On one hand, you have inflation. On the other hand, you have the economy. And the Fed is hoping, or has been hoping, that inflation will break before the economy because higher interest rates bring inflation down. Higher interest rates also hurt the economy. The question that everybody's been sitting on the edge of their seats trying to figure out is what is going to break first? Is it going to be inflation or is it going to be the economy? And this is where now we're starting to see more pain in the economy. We're seeing it especially in the banking sector. We're seeing it in other parts of the economy too, startups and valuations. But overall, we still have low unemployment. The economy is still generally considered strong, but the economy is definitely showing much more red flags than there were 6 months ago or 9 months ago. While inflation, yes, it has come down off of its highs, but it's still extremely high. And this is where now the Federal Reserve Bank is hoping that these higher interest rates will cause inflation to go down without causing a lot more pain in the economy. So it's almost like this balance where hopefully inflation will break before the economy, but no one really knows what's going to happen. And if the Fed has to keep raising interest rates aggressively, well, that can cause more pain to the economy. And you can see now where the potential dilemma lies. If they break the economy first and inflation is not fixed, then what do you do? Because if the Federal Reserve Bank keeps raising interest rates, it puts the United States into a tough recession. You see millions of Americans lose their jobs. You see more bankruptcies happen. Then what's going to happen if inflation is still not down to their goal? Because you're going to see a lot of pressure by people in the government, by people to say, you need to stimulate the economy. You got to cut interest rates. You have to turn this thing around. You have to add more money into the economy. And sure, if you do that, that will stimulate the economy, will create more jobs. Businesses will be able to invest more and things can start growing and booming again. But what's going to happen to inflation? If you already have an inflation problem and then you start stimulating, that's going to make the inflation problem worse. And that's what makes now so unique, especially compared to previous recessions, because in 2020, 2008, and even 2000, and even previous recessions, going into the economic slowdown, there was no worries of inflation. I mean, there's always worries of inflation, but there was no actual high inflation problems. Before 2020, inflation wasn't something that people talked about or even really understood. Before 2008, inflation wasn't something that people talked about or understood. Before 2000, inflation wasn't something that people talked about or understood. But today, inflation is something that everybody knows because inflation has been such a big problem in our economic system right now. It hurts the average consumer. And so now, when you have inflation that's already a problem and the economy is starting to get hurt, and if the Federal Reserve Bank has to keep raising interest rates, well, if they started to reverse and they started to stimulate the economy, sure, they can boost the economy, but then that's going to make the inflation problem worse. And then if you make the inflation problem worse, then what happens? Sure, you create a boost to the economy, but the dollar starts to get hit. The currency that we use to transact, the currency that all of our businesses use, the currency that represents the health of our economic system, then gets devalued. That's what inflation is. Inflation is the devaluation of our currency, because the buying power of each individual dollar goes down, causing the price of things to go up. So inflation is literally our currency being devalued. And if that continues, then that creates even bigger concerns in our economic system, not just that our economy is slowing, but that our currency that we run our economic system with is being devalued. Now, of course, we have a lot of benefits here in the United States, being the world's leading superpower. We are the world's economic superpower. We are the world's strongest military presence. But all these things are happening, and this is where you want to pay attention to not just what the Federal Reserve Bank does, but to inflation and to the economy and to what's going on with interest rates. Because all of these things are coming together now, and as we see more and more pain in our economic system with things like First Republic Bank, with things like the Bed Bath & Beyond, things like more layoffs happening, it's going to put more pressure on the Federal Reserve Bank in the coming months as to what they're going to do. And if the Federal Reserve Bank stays true to their word to bring inflation down, then that could mean that the economy could break first, and that's going to impact a lot of people. Now, again, recessions, while they suck, are a part of our economic system. They have happened pretty much every decade for the last century, and they will continue to happen. The problem is when you try to avoid recessions, you try to avoid the economic pain, the next recession, the next crash becomes even bigger because now you didn't let the economy reset in the first place. And this is where when you try to desensitize yourself to pain, you try to avoid any sort of the economic pain, you make the problem much bigger and the long-term pain even larger. And this is where now we're facing a tough situation where, yeah, it looks like we're going to be entering more economic pain while most people don't want to see it or they're going to be blindsided by it. This is where understanding no matter what happens, you want to be financially prepared. That way you can take care of yourself, your family, and your community. But in order for you to do that, you have to prepare when times are okay. That way you can have money put aside to protect yourself, but also have money put aside that way you can capitalize on other opportunities that might come your way. It pays to stay up to date on what's happening, and that's why I created Market Briefs, which is my free financial newsletter, which is why if you have not joined Market Briefs yet, I highly recommend you do so. It's a free and simple way for you to stay up to date on what's happening in the top financial news with things like the banking sector, the housing market, the stock market, the economy, and everything in between. It's a completely free newsletter. You can read it in less than 5 minutes every morning. And I got the link to how you can read Market Briefs down in the description below. Retirement used to be known as a three-legged stool, where one leg was your pension you got from your company, a second leg was the social security you got from the government, and the third leg was your own personal savings or your investments. Well, now what we're seeing happen is that pensions have become a thing of the past because companies don't offer pensions anymore. Social